How's it going, everybody? I just wanted to talk about some of the lessons and mistakes I've made and learned from investing and starting to invest. And I wanted to start with some of the mistakes first, things that I learned from, things that I could have improved if I, had 2020 vision and hindsight was 2020 or whatever the saying is, right? But yeah, I just figured I could share it for other people who either haven't started yet or have started and are just can see themselves going down the wrong path based off of the things that I describe here that led me down my incorrect path when I started investing. So this is in chronological order from the year 2024 to 2026. That's my whole investing career thus far. Hasn't been very long. I am currently rounding out to 30,000 in the TFSA, so it's coming along well now, but I want to highlight some of the hurdles that would have deterred me from some of the growth otherwise. The first one would be not starting earlier. That would be number one. I wish I just started earlier. If you're hearing this and you're already interested in starting and you're thinking about it, you should start. I wish I started earlier. I thought about it for years and I just kind of pushed it aside until I finally thought, like, why not just try something? Something's got to give. Let's do something new, and it was a good idea. Now, for actual mistakes, the first one would be I entered into volatile and unsafe assets before entering into anything that was worthwhile, anything that was safe, anything that was, actually made sense, any ETFs, any blue chip stocks, anything like that. I think my first few purchases, to be specific so you have an idea, was some Canadian weed stocks, maybe some Canadian utilities, some seriously small name ones, Bitcoin, Ethereum, Solana, XRP. Truly not good investments for the most part. Not saying these things can't make money, but they're not something that most people understand. They're not something that most people need to be putting their money on. It's not going to increase your net worth by speculating on things that you don't understand. So when I started, I would have been better off if I stuck with my initial plan instead of hemming and hawing and buying things here or there and entering unsafe assets, like I said. Number two would be once I finally entered into safe assets, I was entering safe assets. I was entering into the wrong ones. So what I mean by this is when I started buying ETFs, I started purchasing the wrong ETFs. Like I started purchasing covered call ETFs, which isn't for me and isn't for a lot of people. A lot of people aren't going to understand what they are, and even if they do, it's not what a lot of investors are looking for. So I got out of those fairly quickly, and wish that was a mistake I didn't make, but it was not a big mistake. Like, it's not like it impacted me very much, but it's just things that I noted that if I didn't do, I would be better off. Number three is a big one. It was a big one for me, which I call diversification, is not diversification. The ETFs that I chose were not market index ETFs, and they resulted in my portfolio being heavily concentrated in the Canadian financial and energy sector when I was acquiring them. Nothing really wrong with that, just that it didn't fit the overall plan of what I was trying to do. So it worked kind of against what my end goal was. Here I am trying to broadly diversify across the world, and I'm picking Canadian single stocks. Even if they're doing well for me, it's not diversified truly. I was also buying a lot of things, like as you're going to see in a couple of these mistakes, it was very spread thin. So diversification only hurt harder, which you're going to see in a couple points. Number four was focusing only on Canadian currency assets, because I feared the exchange rate. Often your returns will adjust for the exchange rate fees anyway. It's definitely something you should pay attention to, don't get me wrong. It adds up, especially when you have large amounts of capital. It's going to add up a lot. But as somebody who doesn't have a lot of capital and didn't start with a lot of capital, there's almost no difference to buying Google fractionally to when you buy it in a lump sum. So if you're going to pay $50 for it, or you're waiting to pay $1,000, just pay the $50. I waited all year, all 2 years, thinking that I was hurting myself by paying that exchange rate, and you absolutely are, because you're losing money in the fees, but you also gain it back in the capital gains as well if that stock performs how you expect it to perform. And no stock can expect to perform but hopefully you're going with something safe. You check the financials, you read the balance sheet, so on, right? So you understand what you're getting into. You've done your due diligence. Number 5, single stock picking. I didn't even know how to read company financials or do any of the things I just listed 10 seconds ago. And here I was speculating on tons of single stocks, like a 40 single stock portfolio or something like that. Granted, a lot of them were positive. It doesn't matter. That's not investing, that's gambling. Some tickers, when I look back now when I was trying to do this video to like think of all my mistakes, I didn't even recognize some of them, to be honest with you. But yeah. So number 6, dividend stock picking. I am 25 at this point. I don't have the capital or the need for monthly income. I don't have the capital to make monthly income noteworthy, so there's no reason for me to be doing it. You're also just kind of taking away from your capital gains at that point, and your capital gains will compound from the years and years you have, especially in my case, right? Number 7, spreading capital too thin. Too many holdings. Being truly diversified is good, but if you have a $1,000 portfolio with $50 investments spread across 20 stocks, you won't see much return. And I'm pretty sure that was exactly what I was doing. Many of them were up quite a bit. Some of them were up even 60%. It doesn't change the fact that that was not diversified, nor safe, nor was it truly investing. That was essentially just gambling. Over to number 8 here. Daily watching the price, canceling orders if the price fell a few quarters and rebuying it. This is more effort spent than money gained and kept me over emotionally invested. I don't even know how to explain this one. I don't think most people would get it, but when I would do my buys, the price would drop a little bit on my brokerage afterwards, if it did, and I would cancel it to rebuy, which just made me way over emotionally invested for the sake of 20 or 30 cents, which it took me a couple days to realize that this is stupid as hell. But yeah, that was a stupid thing I did. So that was a mistake that I made. Number 9, starting large positions in single stocks that I haven't researched, resulting in emotions impacting investments. Yeah, that one's just cut and dry. Number 10, getting emotionally involved with a stock can make you blind to the full picture of the company. That was a big one for me. Getting emotionally invested to the gains, like getting attached to the CEO, getting attached to the team, getting attached to like the marketing, like it's not good. Number 11, buying the dip with all your capital just for it to dip more. That was many mistakes, not being able to identify the actual dips in the market and understand market sentiment, and buying, dips a little, you buy it right here, and it actually, the bottom was right here. You're never going to time the very bottom, don't get me wrong, but there's obvious signs sometimes when things are going to go bad, and you keep buying at all-time highs and keep buying at all-time highs. Number 12, speculation on sector trends. This one hurt me. You can't really speculate back and forth on things that are constantly happening in the world. AI, quantum computing, critical minerals, arms trades, and militarization, and so on. If you're trying to switch your portfolio every time something happens in a sector that influences you to want to change your investments, then you're never really going to see much compounding capital growth. Chasing sector trends is also going to leave you with a lot of buying at all-time highs and selling low. Number 13, listening to others, especially social media. That's why we always tag every post with, this is not financial advice. If anything, this is financial literacy for communities. This doesn't cost. I don't charge. I don't make a lesson plan. I don't ask for subscribers. I don't ask for likes. I just make the videos and release them to help other people understand their path too. So don't get carried away listening to people on the internet, even if it's me, even if it's someone else. A lot of them get paid to do this. A lot of them have reasons to incentivize certain stocks, like banks will come to them and ask them to promote a stock marketers, like the company themselves will come to YouTubers and influencers and ask them to push them. People will promote the stocks they're bag holding, so on. So just don't listen to people for your investments that aren't people that you trust, that aren't people that you're paying. And then you got to be careful if you're paying them as well, because you don't know if they're trying to sell you a service or a product instead of actually looking out for your main benefit, So just do your due diligence in all aspects when you're doing this. Number 14, not knowing when to sell, holding too long, or purchasing more at all-time highs. I am bad for all of those. I've held a couple too long, still made profit, just it wasn't what it was, and I've definitely made the mistake of purchasing at all-time highs. It sucks, but you just got to keep buying at all-time highs, all-time lows, mediums, dollar cost average through everything, just always buying, and it ends up not mattering in the end. Your average cost even out. Number 15, not setting goals in stock price / not sticking to goals and getting greedy. This is kind of similar to the last one, where when something is really on a rise and it's just blowing out of the water and it's hitting 50%, 60%, 70%, knowing when to call it. Like, maybe I should call it at 100%, then it hits 100%, and it's like, maybe it'll be 110. Then it doesn't hit 110, then it goes under 100, and then it goes under 50, and now you regret not selling it, right? You get greedy. So not getting greedy was a big one. Number 16 would be believing a stock will bounce back instead of cutting your losses or buying more of a sinking ship. It's one thing to be buying something that's on a dip, but if the financials are clearly draining, if the company is burning resources, so on, and you're buying more of it just because the share price is declining, you might be in for not the best ride, right? Like, look at Constellation Software. It's a great company in my opinion, but if you started buying it when it started dipping and that was where you put most of your capital, you'd be quite negative for a while now, well underperforming the market, right? Number 17, not knowing when to buy, panicking when your favorite assets finally go on sale. Like back in April, Liberation Day, everything started going on sale. I did buy, to be fair. So this wasn't really a huge mistake, but at the same time, there are other times in my investing career where I didn't know when to buy. Like, as you'll see with some of the other ones, I sat on cash for a long time because I thought the markets would correct, and they didn't, right? It's not really how this works. So yeah, not knowing when to buy or panicking when your favorite assets go on sale, like panicking when things go down. That was a pretty big one. Number 18, rushing to sell. So many stocks I waited until break-even point to sell for pennies, or just have the stock continue rising drastically sometimes in price. This was mainly for those little positions that I started with those 40 tickers. I was like $20 here, $20 there, and some of them went down a little bit and I was just waiting for break-even to sell it. There's been a few somewhat larger positions where it shot up pretty hard, like Whitecap Resources I was invested pretty hard in, and it shot up pretty high after I sold it for like 30 cents on the break even or something like that. But yeah, that was one that I learned my lesson on. Like, let your winners win and cut your losses when it seems reasonable to do so, when things are clearly losing, like we talked about. Number 19 is not staying consistent with my purchases. I actually have a whiteboard back here which will show you in the end where my exact purchases throughout the years were, and there's a whole string of me not applying any money at all for almost a half year. I was saving up for a car, but still, you gotta stay consistent with your purchases, especially if you want compounding interest to do its magic. You gotta be putting those contributions in consistently, especially if you want to be catching the highs, the lows, the mediums of the market, instead of just putting all your capital in at once and only capturing the highs. You gotta be purchasing all the time. Number 20, letting news create emotions over your investments, but also at the same time, not paying attention to the company or sector news could be a mistake as well, especially in single stocks or volatile sectors in assets like silver or quantum computing. So don't pay attention to the news and don't let it freak you out. But if you're invested in single companies or volatile commodities, you should be invested in what's going on in the world or what's going on in that company. Just don't let the daily news shake you, especially when it's not news coming from that specific company. Like, if it's a headline about said company, like Canada's talking about Brookfield again, don't let the news impact you. You did your research on the company. You know what that company is worth. Just because the sentiment has changed doesn't mean the fundamentals of the company have changed. Number 21, not purchasing enough during market downturns, Liberation Day and tariffs. That created generational buying opportunities, COVID, things like that. I wasn't investing in COVID, so I can't even speak for that one, but generational buying opportunities that I more or less missed out on because I didn't have the capital. I was saving for a car, but at the end of the day, those aren't, like, that moment comes along, you need to deploy everything you got, sell shit, you know what I mean? Like, if things really dip that bad, you need to be buying for real. Especially your favorite things that you're already holding, your ETFs, your big blue chips. Your number 22, I was buying REITs for the same reason. Buying REITs was the mistake, but I was buying REITs for the same reason I was buying dividend things, and I realized I don't need monthly income for the same reason I don't need monthly income from dividends. REITs also lag real estate returns really hard, like really hard. So it really kind of underperforms the actual underlying asset. Wouldn't touch it myself. 23, started buying US holdings, but minimally. It should have increased. I was only buying like $50 here, $20 here. This is back in Liberation Day because American assets went on sale so hard. It should have been way more. It should have been like actual entry level positions. I just didn't understand, wasn't ready, didn't do due diligence, didn't want to, you know what I mean? Number 24, opening a managed portfolio. The managed portfolio did not perform nearly as well as when I self-managed. That's not for everybody. Everybody's going to be different. If you're underperforming the market, you should probably just have somebody manage your money. But yeah, I personally had no need for that, and that was a mistake ever really going with that. I always had my self-managed one alongside my portfolio one, so it didn't really impact me, but it would have been a mistake if I just jumped on the portfolio is kind of the point I'm making. Number 25, there was a long period where I prioritized the liabilities, such as the car I was buying, and put investing on pause through the years of the best buying opportunity, really, like the Liberation Day, like I said. And not even just that, like all the way through, well, let's look. Actually, I can see it right here. I put money in every single month, it looks like, except for May, June, July, August, September. Yeah. So there's a good almost half year that I didn't put money in, right? Because I was prioritizing a car, because I was prioritizing other liabilities that I didn't need, consumable goods. I should have been putting money in, even if it was a minimal amount, every single month regardless, so compound interest could do its magic. 26, staying in cash, hoping for the markets to correct when they never did, giving up months of the best gains of the year, pretty much exactly what I just said, and we talked about it previously. But yeah, I would not stay in cash. You're losing to inflation, you're losing to taxes. Like, there's no reason to it. Like, why would you ever sit in cash? You know, like, your money could be increasing, and it was really stupid to sit on the sidelines for that long. I missed out on probably like some of the best gains of the entire year, honestly, and that year was a big rally. So but it is what it is. Number 27, fact check, research, but also follow your gut instincts rather than FOMOing over trends. That means fear of missing out. If I stuck to my plan of buying gold and silver and Canadian broad market ETFs, and like, for instance, the Canadian gold miners, Z Gold, and things of that nature, alongside like QCN, VCN, Canadian broad market equities, instead of speculating on AI, quantum computing, junior miners in Canada, so on, or which geographical sector will be the next to outperform, I would have made way better returns if I just focused on what I believed was true, just followed my gut instincts instead of speculating and trying to hit that 1000% whatever. Doesn't make sense. Just play it conservatively. You know what you know. That's it. Number 28, buying very risky assets in a TFSA, a risk and contribution room that you can never get back. Bitcoin, Ethereum, ETFs, single penny stocks, so on and so on. Options. I never did options, but I'm just saying. 29, not doing any research and throwing money at a moonshot, resulting in pump and dumps that would have seen coming if I researched the company or the CEO at all. With this specific instance, I didn't even Google them to make sure the company was a legit real company. I didn't even call them. I didn't do nothing. When I did call them, their phones were disconnected. They weren't even a legit company. Like, I deserved it. I got what I deserved, and I learned my lesson, right? So that's a big one. Number 30, substantial greed whenever a stock has an absurd performance, believing it will go higher when it's already unrealistically high. We kind of talked about this one with getting greedy. Number 31, not simplifying and holding a broad market index ETF such as XEQT, but not simplifying and just holding one of those from the start while I built my core portfolio. I kind of did it backwards. I did the single stock gambling and the crypto, and then the ETFs, and then the broad market equities. So I probably should have started with XEQT and then worked my way up through the ranks instead of, going backwards. But again, we're here, so we made it. 32, not learning from mistakes and recognizing my own patterns is a big one, because if I make all these mistakes again, then what the hell is the point of even writing them down and listing them to you guys, right? 33, not having a clear investment goal, which goes in with 34, not having a clear investment strategy. You need to have a strategy and a goal. You need to have rules to this so that you know when to cut your losses, or take your gains, or whatever it is. If you want to be swing trading, day trading, long-term holding, whatever it is, you got to set your rules and know your rules and abide by them. And then number 35 is the same thing as number 0, not starting sooner. So just want to emphasize how important it is to start as soon as possible. The second you see this is the best day. If you didn't already start when you were younger, the best day is today, right? So we can only regret so much. We just have to do better than what we're doing now. So yeah, those are all my mistakes that I made in my TFSA.